Guys, there are 5 stocks that I will be buying in July of 2024 if the price hits the value I need it to hit. And that's the big key. Stock number 1, let's take a look at PayPal. Now, I own PayPal. It's becoming a very popular stock amongst value investors. I have no idea where it's going to go. But remember, don't buy a stock just because I or someone else on the internet owns it. This channel is about teaching a process and take pieces of it that work for you to apply. Now, PayPal is down to $58 a share. It's getting kind of attractive here, even more attractive than it was before. Now, if you remember, look at this chart. All-time high of 310 back on July 26, 2021. Great place to look for value is when stocks are falling considerably. But just because something is less price on the stock does not necessarily mean it is a good buy. Let's go check out the 8 pillars first. Because remember, 8 pillars tell a story. And the story I want to see here is all 8 check marks. Okay. Now you might be thinking, oh, it's 8 check marks. That's not the purpose of the 8 pillars. The 8 pillars are to sit here and tell that story. So one thing I do notice, the PE is a lot higher than the price to free cash flow. That's a good thing. I like that's a lower ratio. That means there's more free cash flow than earnings. And you'll see right here on the 5-year number, $4.78 billion in free cash flow, $3.5 billion in net income. We like this. This is a positive thing. Okay. Profit margin, around 14%, pretty consistently. Now, ROIC isn't that great, but I think it is getting better. They are buying back shares. I like that they're buying back shares at 12 times free cash flow. That to me makes a lot of sense. When stocks are cheap, you need to buy back shares as a company, okay? Now, let's go see what analysts are saying, because I like looking at what analysts have to say. Not necessarily going to agree with them, but it's a good starting point. Look at this growth. Yeah, it's a drop this year of 15% in earnings per share, but growing pretty steadily to over $8 here in the next 3 or 4 years, according to analysts. And the revenue growth for this dying company, 8%, 8%, 7.5%, 7.5%, 10.5%. I keep hearing people say, PayPal's dead. Guys, the number of active accounts they have decreased, but the total transaction amounts and the average transaction per user is much higher and growing. That's the big key. Do I like the fact that number of accounts is decreasing? Absolutely not. I don't like that. But the other 2 metrics and the fact they're not just growing by a few percentage points make me feel very good. So why do I like this company before we get into stock analyzer? Trustworthy. I always ask people, why do you use PayPal? I trust them. Whenever I buy something that I need a little bit more, like something high priced or something international, I always use PayPal because I know they're going to have my back if something were to happen. So stock analyzer tool, let's pull up PayPal. The last time I did it was April 8th. Now I did a 10-year analysis. Look at this, 1-year ROIC, 12.4%. Very nice. Revenue growth, I did 4, 7, and 10%. Profit margin, 12.5, 15.5, 18.5. The reason I went higher here is as their revenue goes up and up and up, their gross margin will really add more to the bottom line. So I do think they can get that, but I'm actually going to go a little bit lower here. I'm actually going to go to 14.5 just to be conservative and 16.5. Free cash flow, as you can tell, is much higher. So I did 16, 20, and 24. PE, I did 13, 16, 19. I think I'm going to change this to 14, 17, and 20. And the reason being is I think that whole trust factor is very important. I think the Venmo aspect is very important. And I think that if you want to have more margin of safety, like usual, put it in your desired annual return. I'm putting 9% in here because 9 or 10% is the market. And this is for intrinsic value. I've not added my margin of safety yet, but it's important to do that because future's unknown. We're humans, we make mistakes, and valuation is an art. It is not a science. If it were a science, you'd all just put the numbers in, be done, but you have to analyze how is this company going to grow. I hit the analyze button. Stock's currently at 58. I have a low price of 56 to 70, high price of 145 to 215, a middle price of 90 to 126. I like these odds. So as the stock falls, I will buy more of it. Now, I want everybody to remember, we're in what I consider to be a frothy market. All the stocks I'm going to mention here, if we have a bad bear market, are going to probably go down with the stock market. But it's about differentiating between the stock market dragging a stock down versus fundamentals dragging a stock down. That's the big key here. You could end up loving PayPal, do your own research, love it, buy it. But the whole key here is to be able to buy it when the stock is falling. Stock number 2, Ulta Beauty, one I just recently bought. All-time high of $575 just back in March. It is now already at $387. Quite a big drop. $200 on a $580 stock. That is almost 40%. What is that? That is 35% or something like that. That's a lot. It just shows you how fast things can fall. 3 months ago. Just in 3 months, it's fallen that much. Okay, now the reason I like it, they've still had same-store sales for a retail location. Love that aspect. Now, one thing I'm not a huge fan of, if you look at their 1-year free cash flow, it's $915 million versus 1-year net income of $1.25 billion. But 5-year free cash flow of $885, 5-year net income of $905. This is 2% apart. I'm okay with this. That's why we look at the whole story, not just focusing on 1 year. Gross margin, almost 40%. Bottom line, pretty consistent between 10 and 11%. No dividend. You know what else I love? $18.8 billion market cap. $21.5 billion enterprise value. That difference of $2.8 billion is essentially the debt. And this is retail. So they have a lot of leases there that count as debt. All right, let's go see the 8-pillar story here. Another 8-pillar thriller. And like you said, look at these things. Buying back shares. Love that at lower prices. Net income has grown $820 million versus cash flow of $377. Okay, not the best. And not the best that revenue has grown $4.47 billion, but free cash flow is only up $377. So it's about understanding that. But look at this return on invested capital, 23%. Now, do I think retail has a lot of issues? Absolutely. There are issues, but Ulta's done a good job of they're also opening in Target stores, which I think is great. So they're doing some partnerships to get out there. They love appealing to women. Women love to spend money on these things. So this is why I like the company. And I do think they're a very niche company that as long as they don't outgrow themselves, because there's a possibility of outgrowing yourself, I feel pretty comfortable and I like to buy more as time goes on. I do have puts at lower prices. Let's see what analysts are saying. Analysts think the stock EPS is going from $26 to $43 a share in the next 5 years. Pretty much double-digit growth every year except for one. Look at this revenue growth, guys. I'm actually surprised by this. 5, 6, 6, 7, 6. So it's going to be a combination of same-store sales and a combination of opening stores. Okay, not bad. So what's our stock analyzer tool? Probably going to adjust this one a little bit. Pull up Ulta from 523. No, I did 3, 5, and 7% revenue growth over the next 10 years. 9.5, 10 and a quarter, 11. Same thing for free cash flow. PE, I did 15, 18, and 21, mainly because of its increasing ROIC. So last year's ROIC was 29%. That's pretty impressive. And again, my no margin of safety, 9% return. Hit the analyze button. I've got a low price of $340, a high price of $660, a middle price of $476. At that $476 price, today, based on today's price, that discounted cash flow offers me almost 12% return on that. So yeah, I'm going to be writing more puts. I think I have some puts out there at $365 and $350, but I'll be writing more puts on this company as time goes on. Stock number 3, Starbucks. Starbucks all-time high of 126. It's down to 79, so it's not that big of a fall, about 35%. And the all-time high was back in July of 2021. But guys, July of 2021, that was 3 years ago next month. 2 years and 11 months ago, it hit its all-time high of 126. It pays a dividend, about 2.8%, that eats up $2.5 billion of its $4 billion free cash flow last year, and pretty much all of its 5-year average free cash flow. Not a fan of that. Not a fan of that. I'm also not a fan of the fact that the 5-year free cash flow is significantly lower than the 5-year average net income. But it's Starbucks. There's 35,000 plus stores worldwide. They're starting to condense some stores, like close some off. So I really like that idea about Starbucks. And remember, I'd ask you, how many Starbucks there are in China, India, Africa? There's probably still a lot of growth potential there for Starbucks. So what's the 8-pillar story telling us? All right. So we have X's on the valuation, first one. Starbucks is a great brand, so I do think it justifies a higher valuation. Look at this, high return on invested capital. That screams moat status right there. And we have a high debt level. Again, lots of locations, and they're premium locations, so they cost a lot of money. So that doesn't worry me so much, okay? Cash flow growth, $3 billion growth versus net income of $768. That's solid. And that $3 billion cash flow growth came off of $10 billion in increased revenue. Now, What I'd love for them to do is, if the price gets cheaper and cheaper, cancel this stupid dividend and buy back shares. $2.5 billion in dividends could buy back 2.5% of the company, 3% of the company today. Let's focus on that, guys. If the stock gets cheaper, it becomes nosebleed cheap, you got to sit there and focus on that as the company. So what are the analysts saying about StarBizzle? $3.67 a share in earnings per share, going to $6.44 in the next 3 or 4 years. That's pretty good growth, double digit every year. And revenue growth, all right, mid to high single digits, 2.5, 7.5, 8.5, 10.5, 8%. Pretty solid growth. Again, new locations as well as same store sales. Let's go to Stock Analyzer, pull up Starbucks, StarBizzle. So, revenue growth. I did 5, 7.5, and 10%. And by the way, look at this ROIC just increasing. I did profit margin, 10.5, 12, 13.5. I did a slightly lower free cash flow margin of 10, 12, and 14. Now, PE and price of free cash flow. This is a premium product. Is this reasonable? 17.5, 20, 22.5. Guys, you tell me, what do you think? Comment below what you think the right multiple for Starbucks is, because obviously it shouldn't be a 15 PE company because it's a premium, it's a moat, all these extra things it has. I just don't believe it that it's a 15 PE company or lower. Is it 30? I don't know. I don't think so. I stuck with 17.5, 20, 22.5. Let me know what you think. And then for desired return, again, no margin of safety, 9%. Hit the analyze button, boom. A low price of 62 to 66, high price of 150, middle price of 100. So it's selling at a 20% discount to my middle value. Now, guys, I'm sure you've noticed we have a wait list for EM software. And the reason for that is because the software as it exists today includes everything we have to offer for stocks, retirement, and real estate and all these tools, okay? Now, we are making some changes behind the scenes. So in a short period of time, that full offer, including everything, will absolutely be going away. As we've been getting feedback from our customers, people prefer us to focus for them. They don't want to have the Cheesecake Factory of options when they're using Everything Money software. Now remember, 2.5 years ago, I built the software. I built it for me, and I built it completely selfishly. But then users started saying, hey, how do I get access to that? How do I get access? That's when we opened it up. But now, as we've grown, it's becoming less and less about me and more about how I can serve you much better. This is why we're going to update our software to give you exactly what you need. Now, the good news is we have not made those changes yet. So if you go below, click on the link below to sign up for the software, you will be grandfathered in for life with everything because this is the best deal we're ever going to offer. And I'm telling you this now because there's still time for you to go click that link. As long as you join the EM community before we make the changes, you'll be able to keep the plan even after we make these changes. So click that link below in the description, get access to everything we have to offer, and it'll be the best decision you have made all year long. Now, stock number 4, Paycom Software. This is an interesting one. I bought Paycom after it fell one day dramatically from 200 down to 150, 145. I bought it, then it skyrocketed back up. And now it's coming back down again. It's at 141. Now, my concerns about Paycom are very simple. It's payroll. And if we hit a recession, my guess is Paycom will suffer hard, okay? A couple other issues I have with Paycom here. The 1-year free cash flow is significantly different from the 1-year net income. And I'm wondering how much it's affecting the 5-year free cash flow versus 5-year net income, okay? It is selling for a high 28 times free cash flow in the last year. Only 17 times earnings, all right? But great gross margin, 83%. That means for every dollar they bring in, it's 83 cents the bottom line, all right? Great revenue growth potential. This is a company with a good return on invested capital, great revenue growth potential, selling for 4.5 times sales, even with such a high gross margin. This is pretty solid stuff here. Dividend is $86 million, poop on that. But look at this. Let's go look at the 8-pillar story here. That's what we love. The story is telling us, is it valuation? I do not like this discrepancy between earnings and free cash flow, but they're growing and they're growing fast. So that could be a big part of it. Revenue growth, almost $1 billion. Net income is up 27% of that. Free cash flow is up 16% of that. Very little debt. 1.75 times their 5-year free cash flow. That's it. They have very little long-term debt. Shares outstanding, down 3%. Okay, so guys, there are a lot of issues with this company going forward. And I don't want to, I mean, by the way, look at this. All-time high, 560 back on November 2nd. But remember, 2021. Remember, it's not just about where the stock has fallen. It's about where it's going. In the short run, stocks are a voting machine. People obviously loved this company back in 2021. Why? No idea. No clue. You never know. Usually it's because something starts to go up and up and up. More people pay attention. They start to get on the bandwagon. It keeps going, and then boom, maybe a precipitous fall. But remember, this is a company I'm going to look at from a long-term perspective. Let's see what analysts are saying for this company's earnings per share. About 50%, 60% growth in the next 4 or 5 years. 13.5, 19, 5, 13%. Okay. So pretty solid earnings per share growth. Revenue growth, double digits, 11, 11.5, 12, 12.5, 11. So very solid revenue growth numbers as well, with 83% gross margin. As they really drive this up, I'm actually surprised they don't have earnings per share growth be much higher. I do think that as we're more and more stay at home to work, things like that, the software for HR and payroll will be very, very important. Paycom seems to have a very good balance on that one, as well as access to it. So let's pull up the last time I did Paycom just a few weeks ago. I actually did a 20-year analysis here, guys. 20-year. So I'm not looking at this from just a short-term period of 10 years. But I did 6, 8, and 10% revenue growth, okay? The last 10 years, I did 31%, 23%, 18% in the last year. Profit margin, I did 20, 23, and 26. Free cash flow is lower. I did 18, 21, and 24. PE, 17, 20, and 23. Same with the price of free cash flow. Again, the 9% desired return. Hit the analyze button. Got a low price of 135 to 150, high price of 350 to 380, middle price of 240 to 220. So this company seems to have some good margin of safety, and I'll be selling puts at much lower prices. This is a company that I think will have a lot of volatility. Like if we have a recession that hits hard, where does the stock go? 50, 60, 70? I don't know. And you might sit there and say, well, Paul, if you think that, why are you buying it? Well, because I don't know what's going to happen. I've made those mistakes of sitting there saying, I'll wait for a pullback. What I'm trying to do is buy a good company at a good price. And then if it goes lower and the fundamentals are still the same or the story is still the same, I buy more of it. My guess is if we hit a recession, the fundamentals will not be good. But once that we get out of the recession, it'll pop right back up. And that's the big key. So I do expect that this company, all the companies I buy to fall, and I can keep on adding them as they fall. So my cost basis decreases. Stock number 5, Disney. Very simple on Disney, guys. My play is purely a profit margin play. According to this, the last 5 years profit margin is 2.4. Last year was 2%. Let's go to their net income. Let's go to their income statement and see what history has shown. So before COVID, they did $70 billion in revenue in 2019, followed with $11 billion in profit. So 11 out of 70. What's that percentage? About 15%. 15% margin. Okay, remember, last year they did 2%. Okay, the year before that, they did $60 billion in revenue, and they did $12.6 billion in profit. What is that? That's over 20%. And it goes on and on and on. Their margin is not a 2% business. This is a company that I think has a lot of potential. Once they get back into their profit margin level, that this company could do very well. But what's interesting to me is that they haven't been selling for dirt cheap prices based on that profit margin. Here are what analysts expect. 478 this year, which is a 30% increase. Look at these growth rates for EPS. Going to 767 in 3 or 4 years. I think it could be higher. And the revenue growth, mid-single digits, about what we'd expect for a company like Disney. It's huge. How are you going to grow 10, 15%? You can't. And hopefully they're able to make more money off Disney Plus. And really, it's a high margin business, but it's been hard to make money. I'm making this play purely based on profit margin. So let's go pull up our good old stock analyzer. And I did 3, 5, and 7% revenue growth. I did profit margin of 9, 12, and 15. And I did PE of 18, 21, and 24. Guys, I could see this being higher. I just did Paycom at 17, 20, and 23. So I think for Disney, does it justify a higher PE than this? Probably. 9% return. Scroll down below. Low price is 75, high price of 200, middle price of 128. So guys, if you want to see the 33 stocks that I want to own, watch this next video. Thank you very much for your time.